Gold is rising. Even as one of the biggest forces that should be crushing it is getting stronger. Real yields are climbing. The bond market is sending a warning. Yet gold refuses to behave the way the traditional chart says it should. So what is the market, seeing that most investors are missing? Because behind this chart, something much bigger may be changing. And if the next signal confirms it, the consequences for gold, silver, and global capital could be far more significant than anyone expects. Welcome to NEX Alert. If you've been watching markets for years, you already know that the obvious signal isn't always the important one. Subscribe to NEX Alert and tell us from where you're watching today. Which country are you joining us from? For decades, one relationship has been treated almost like a rule book in the gold market. When real yields rise, gold struggles. When real yields fall, gold tends to strengthen. The logic is straightforward. Gold does not pay interest, so when inflation-adjusted returns on government bonds become more attractive, investors have less reason to hold a non-yielding asset. That relationship is precisely why the current market deserves a closer look. The chart appears to be sending a warning. Real yields have been moving higher, creating a headwind that, under normal circumstances, should make gold less attractive. Yet gold has continued to demonstrate remarkable resilience. Silver has been even stronger. That creates a question that matters far beyond precious metals. Is the traditional relationship between real yields and gold actually breaking down, or is the market revealing something that the chart does not capture? The distinction is critical. A rising real yield can come from different forces, and those forces do not necessarily carry the same meaning. Real yields can rise because investors become convinced that inflation is finally being defeated. In that environment, higher real returns on bonds can genuinely reduce the appeal of gold. But there's another possibility. Yields can rise because investors are demanding greater compensation for lending money over long periods. Now, that is a very different signal. It does not necessarily mean inflation has been defeated. It can mean the market is becoming less comfortable holding long-duration government debt. That difference could change the entire interpretation of the chart. The problem is that the chart most investors watch does not show who is pushing yields higher. It simply records the result, and markets are driven by the mechanism behind the number. If the Federal Reserve raises or lowers short-term policy rates, that is one part of the equation. But the Treasury market has another layer. Someone still has to purchase the government's debt, especially when the government must continuously refinance existing obligations while issuing new debt. If those buyers become more cautious, the price of bonds can fall and yields can rise even without a dramatic change in inflation expectations. That is where the story becomes much more complicated. The pressure may not be coming from the short end of the yield curve, where monetary policy has its strongest influence. It may be coming from the long end, where investors must decide whether they want to commit capital for 10, 20, or 30 years. That decision matters because long-term investors care about more than today's interest rate. They care about future inflation, currency risk, fiscal sustainability, debt supply, and the compensation required to accept uncertainty for years. This creates a potential blind spot. A chart showing higher real yields may appear bearish for gold, while the underlying reason for those higher yields could actually point toward greater demand for monetary protection. And if that is what is happening, then the most important question is no longer whether yields are rising. The real question is why they are rising, and who is willing to keep lending when they do. That is where the next part of the story begins. The most dangerous mistake in a bond market is to look at the yield and ignore the buyer. A Treasury yield can rise for many reasons. Inflation can accelerate, monetary policy can tighten, or investors can simply decide that lending money to the government for decades is no longer worth the risk at the old price. The third possibility is where the market's blind spot becomes much more interesting. The long end of the bond market does not wait for the Federal Reserve to tell it what to do. It has its own decision-making process. Pension funds, insurance companies, foreign institutions, banks, asset managers, and sovereign investors constantly compare the return on U.S. Treasuries with the opportunities and risks available in their own markets. And when those alternatives change, the flow of capital can change with them. Consider Japan. For years, Japan played an unusually important role in the global financial system because domestic yields were extremely low. Japanese capital had strong incentives to travel abroad in search of better returns. A portion of that capital found its way into foreign bonds, including U.S. Treasuries. But that calculation changes when Japanese government bonds begin offering investors more attractive returns at home. The question then becomes uncomfortable for the Treasury market. Why take currency risk, hedge costs, and international exposure when domestic bonds are becoming increasingly competitive? This is not simply a Japan story. It is a story about the global pool of savings. When major economies begin repricing their own long-term bonds at the same time, capital can become more expensive everywhere. Investors who previously accepted lower yields may start demanding additional compensation. The result can be a higher term premium, a steeper yield curve, and greater pressure on governments that depend heavily on long-term borrowing. That pressure matters because the United States does not operate in isolation. The Treasury market must continuously absorb enormous amounts of government debt. Every new issuance requires buyers. Every maturing bond eventually needs to be refinanced. If traditional buyers become less aggressive, someone else must offer a higher yield to attract the necessary capital. This creates a chain reaction. Higher yields increase government financing costs. Higher financing costs can place greater pressure on fiscal policy. Greater fiscal uncertainty can make investors demand even more compensation for holding long-duration debt. The cycle can reinforce itself. And this is precisely why the original gold chart may be incomplete. If yields are rising because investors believe inflation has been defeated, gold faces a conventional headwind. But if yields are rising because the market is demanding a larger premium for carrying government debt, the signal becomes far more complicated. The same rising yield that appears bearish on a traditional gold chart can simultaneously indicate growing concern about sovereign borrowing, currencies, liquidity, and the long-term purchasing power of money. There's another important distinction. A leveraged trader can sell gold because a chart breaks support. A central bank managing reserves does not operate under the same rules. It does not receive a margin call because a futures contract moves against it. It can accumulate an asset for strategic reasons that extend far beyond the next quarter. That difference between short-term positioning and long-term capital allocation may ultimately explain why gold can remain resilient while conventional indicators become increasingly uncomfortable. The market may not be ignoring real yields. It may be responding to something underneath them. And once the identity of the marginal buyer becomes the focus, the entire gold and silver equation starts to look different. There's a type of buyer that changes the meaning of a falling market simply by refusing to leave it. That buyer does not watch every candle on a trading screen. It does not use leverage in the same way as a hedge fund. It does not receive a margin call when gold falls for several weeks. And it does not necessarily care whether the next economic report beats expectations. It is the official sector. Central banks have become one of the most important pieces of the precious metals equation because their behavior can look completely different from the behavior of speculative capital. A leveraged investor typically asks a short-term question: is the position working? A central bank asks a strategic question: what should the reserve portfolio look like years from now? That distinction becomes especially important when gold is falling. A price decline normally creates a familiar reaction. Traders reduce exposure, momentum weakens, and speculative positioning becomes more defensive. On the surface, that can make the market appear increasingly bearish. But if central banks continue accumulating gold during that weakness, the market is receiving two very different signals at the same time. The speculative buyer is stepping back. The strategic buyer is stepping in. That does not guarantee that gold must rise immediately. Markets can remain irrational longer than individual investors expect. But it changes the underlying structure of demand. The distinction becomes even more important when examining futures positioning. Futures markets can amplify both directions of a move because borrowed capital magnifies gains and losses. When prices fall, leveraged traders may be forced to reduce positions regardless of their long-term opinion. This can create a temporary wave of selling that looks far more significant than the underlying physical demand actually is. Physical and official sector buyers operate differently. They can tolerate volatility, they can accumulate gradually, and they do not need the market to validate their decision every afternoon. This is where the original chart becomes less useful as a standalone forecasting tool. It can show that real yields are rising, it can show that gold should theoretically face pressure, but it cannot easily reveal whether a structurally motivated buyer is absorbing the selling. That hidden demand can become especially important during periods of uncertainty surrounding currencies and sovereign debt. If governments continue carrying large debt burdens while investors demand higher compensation for holding long-duration bonds, reserve managers have a reason to reconsider how concentrated their portfolios should be. Gold carries no issuer. It does not depend on the solvency of a government. It cannot be created through a central bank balance sheet. Those characteristics help explain why gold can occupy a different role inside a reserve portfolio than a conventional government bond. Silver presents a different equation. Its market is smaller, more volatile, and influenced heavily by industrial demand. That creates greater upside potential during powerful precious metal cycles, but it also creates greater risk when positioning becomes crowded. Silver can move much faster than gold because relatively small changes in investment demand can have an outsized effect on a smaller market. That means the strongest silver trend can also contain the ingredients for a sharp correction. For investors, the lesson is not that gold and silver are guaranteed to rise. The lesson is that the identity of the buyer matters. If speculative money is driving the market, rising yields can become dangerous. If strategic buyers continue accumulating while leverage positioning remains restrained, rising yields may be telling a completely different story. And that leads to the final question. If the traditional warning signal is flashing red, but the buyers with the longest time horizons are quietly behaving differently, which signal deserves more attention? The answer may depend on one thing the chart cannot reveal by itself: what happens next at the critical price levels. The final mistake would be to turn this entire analysis into another prediction. Markets rarely provide certainty. They provide signals, probabilities, and conditions that either strengthen or weaken a thesis. The real advantage comes from knowing which conditions matter before the market forces that decision. For gold, the first question is whether the structural demand remains intact. If central banks continue accumulating while long-term Treasury yields remain elevated, the traditional relationship between real yields and gold becomes increasingly difficult to interpret in isolation. A high real yield would still matter, but it would no longer be the complete explanation for gold's behavior. The critical level is therefore not simply the yield itself. It is the combination of price, bond market pressure, and buyer behavior. A sustained breakdown in gold below an important structural support level, accompanied by weakening central bank demand, would represent a meaningful change in the thesis. That combination would suggest that the structural buyer is no longer absorbing weakness with the same conviction. But if gold holds its major support while official sector demand remains strong, the interpretation changes. In that scenario, periods of weakness could represent consolidation rather than the beginning of a structural reversal. This distinction is particularly important for business owners and capital allocators. A company does not make strategic decisions because of one day's market movement. It evaluates cash flow, financing costs, currency exposure, and long-term risk. Precious metals should be viewed through the same framework. Silver requires an even more disciplined approach. Its smaller market and industrial component can produce much larger swings than gold. A strong silver trend can accelerate rapidly when investment demand increases, but crowded positioning can also create violent corrections. That means a bullish long-term outlook does not eliminate short-term risk. In fact, the stronger the recent move becomes, the more important risk management becomes. The key question is whether silver is advancing because genuine structural demand is increasing or because leveraged traders are chasing momentum. Those two situations can produce similar price charts in the beginning, but very different outcomes later. This brings the story back to the original chart. The chart was never completely useless. Its mistake was being treated as a complete explanation. Real yields still matter. Inflation expectations still matter. Federal Reserve policy still matters. Treasury demand still matters. Currency movements still matter. But these variables cannot be understood independently. A rising real yield caused by genuine disinflation is one environment. A rising yield caused by investors demanding greater compensation for holding long-term government debt is another. The number on the screen may look similar. The economic meaning can be completely different. That is the blind spot. Investors often focus on what the market is doing instead of asking what is forcing the market to do it. If foreign demand for U.S. debt continues weakening, if long-term borrowing costs remain elevated, and if central banks continue treating gold as a strategic reserve asset, then the pressure inside the bond market could become increasingly important for precious metals. But if Treasury demand stabilizes, inflation expectations decline convincingly, official sector buying weakens, and gold loses its major support levels, the warning changes direction. That is why the next move should not be judged by a single chart. It should be judged by the interaction between yields, buyers, currencies, debt, and gold itself. And that leaves one final question hanging over the market. What if the rising yield everyone is watching is not actually warning investors to get away from gold? What if it is warning them to look much more carefully at the system behind the yield? Because if the buyers of government debt are changing while the buyers of gold are becoming more strategic, the next major move in precious metals may not begin with a dramatic headline. It may begin quietly, inside the bond market, long before most investors realize what has changed.